Yeah, we had two things move the market today. The Oracle earnings, concerns about AI gave us a AI sell-off. We had the NASDAQ actually close lower than NASDAQ 100 as well, but the Dow rose higher by 1.34% of 646 points. The S&P down in negative territory much of the session, ended on a positive note, up 14 points, gapping lower, went back to fill the gap, formed a rising wedge. I'll show you that to you on the 5-minute chart. NASDAQ and NASDAQ 100, they were down. Also was up 1.21%. And let me move this so you can see this. The VIX was down 5.83% to close at 1485, just under 15. Now we get an AI sell-off with Oracle. Now we have Broadcom beating on earnings and revenue. The AI chips sales will double in the current quarter. Now Broadcom had sold off with the Oracle sell-off and volatility surrounding the Fed, but recovered off the lows, ended down 1.60%, currently up just over 3% in after hours. Oracle triggered an AI sell-off today along with the Fed. Oracle, it was down over 15%, I believe, at the lows, ended down nearly 11%. It was down 10.83%. Currently, it's flat in after hours. That was a drag on AI stocks. Oracle missed on earnings expectations. So disappointing earnings caused concerns about its $300 billion AI investment. So it led the charge. And again, I told you we're going to see more distribution with AI stocks, but the Oracle earnings produced that sell-off today in combination with, again, the Fed officially pausing, telling us they're only going to do one rate cut in 2026 and one more in 2027. I mean, that's insane. Recession's about to start, and the Fed is pausing rate cuts. I mean, that is completely clueless to what's about to happen. But yet, Fed's injecting billions into the banks. We've already talked about that in previous weeks. Largest amount in 5 years since the pandemic. Now they're doing this, and this is a huge red flag. And yet people are calling this QE. The fact that the Fed has to intervene, start buying short-term treasuries. QE's long-term, usually long-term. Having to intervene should tell you, and it's a huge red flag. Not waiting to January to do this. They're starting tomorrow. There's an urgency. About to have a banking crisis. The fact that they have to do this shows that something's wrong. But, oh, here we go. Here's QE. This is not QE. This is the Fed trying to stabilize the financial system. Told you we're seeing evidence that a banking crisis is getting ready to happen. This is it. If everything's so wonderful with the banks, why is the Fed having to do this? The last time the Fed did this in 2019, it was right before the recession that happened, before the sell-off with the pandemic. They papered over it. Recession, the bad recession and the bear market we were supposed to have, it's been delayed. It's going to be a lot worse now because the Fed is meddling with the markets. You're going to see economic weakness, and inflation is going to tick back up. But yet the Fed is still going to have to do jumbo cuts because we're moving into recession. Eventually, we'll get a deflationary bust. But we should start seeing weakness with economic data. There'll be concerns about recession. The Fed has now officially paused here, I guess. Eventually, when markets start to collapse, and we're already seeing it happen with Bitcoin, the stock market's about to play catch-up, like what would happen in 2021 and 2022. First Bitcoin peaked, then the NASDAQ. S&P tanked with the NASDAQ at first, and then it moved slightly higher, 1.5% above the previous high, and diverged with NASDAQ. I don't know if we do that again, but Bitcoin has already confirmed a bear market in the daily, the weekly, and the monthly time frame. It already dropped 36%. It's in a downtrend. The market is going to play catch up. The Fed thinks that they can just do this intervention and, it's just going to solve everything. And, we've injected the money, the billions into the banks. And so this is fixed. No, it's not. They're arrogant. They think they can micromanage the economy. Policies always lead to negative outcomes. Now I'm still watching yields. We're pulling back. back into the trading range towards the 50-period moving average. We had the breakout of the bullish falling wedge. We back tested it. That gave us a right shoulder for the inverse head and shoulders that set up with the breakout of this bullish falling wedge. We broke out with a slanted neckline and we're throwing back. Last couple of times we've seen these positive bullish divergences on the MACD. We've seen a big surge with the yield. I want to bring this up close because I want you to see what happened. We sold off, but we didn't close at the lows of the session, and you got a bullish hammer. Do you see this? And we dropped below the trend line, but then we closed just above it. And we moved back towards that 50-period moving average. We have a breakout and a back test, and we're throwing back towards our 50-period moving average, throwing back into the trading range, but then you get a bullish hammer, which has a hollow red candlestick in it for the head formation. So do we begin to see the yield surge with this breakout? Again, the 10-year yield, more often than not in recent history, has had a negative correlation with the stock market. It's giving us a bounce in the weekly time frame off of this trend line right here, forming this massive triangle, which is likely a continuation triangle. Fed cutting now pausing, and if you start seeing the 10-year yield push out and break above this triangle and eventually try to go to a new high, there'll be concerns that the Fed has lost control. Cutting rates, but yet the 10-year yield is breaking out of a triangle and moving to a new high. I think this is going to produce a major sell-off. I think you're going to see an issue with the banks. I keep warning you. Who's talking about this? Nobody is talking about this. Nothing to see here. Oh, the Fed has their tools and they're going to work, and it's absolutely incredible how naive people are. And these so-called experts telling us, oh, there's nothing to worry about. Again, I think you're going to get Jamie Dimon's crack in the bond market. I think this is going to freak markets out. This is the yield, okay, the 10-year yield. If it goes higher, then we should see the 10-year Treasury drop. They have an inverse relationship. Next week, we're going to be getting the unwinding of the yen carry trade. We'll be rising in anticipation of that. We should see the Bank of Japan begin to raise rates again, first time since January. Going to put selling pressure on the stock market, on bonds, on cryptocurrency, on Bitcoin, and people are oblivious that this is about to happen. But the yield can go higher. Again, the unwinding of the yen carry trade, which I've explained at great length and detail. It could be going higher on concerns about inflation and expectation of fewer rate cuts. A couple different things involved in this, but again, I think you're going to see Jamie Dimon's crack in the bond market. I think he will be correct about the bond market collapsing and yields surging. I think that's getting ready to happen right now. Please support the channel with the link directly below that allows me to be able to provide you this information. If you could take a moment to do that, I'd appreciate it. Just follow the link below to take you to a secured site. You could donate any amount you want. I don't have any sponsors, just a direct relationship with you. So please consider supporting the channel today. Now, we did try to get a red bar yesterday at the lows of the session, couldn't do it. We tried it again today on the S&P 500, couldn't do it. Red bar on the oscillator. The NASDAQ did do it. Now, is this just, red bar that's going to be followed by a green bar, or is this going to mount to something? Got a possible bottoming tail or a hanging man, one or the other here. You got a similar candlestick. So if we get more red bars, you got to take out that 10 period, the red line there. You've got to take out the 20 and the 50 down over here, and you got to get a lower high, lower low if this is going to amount to anything. If we go up and fill the gap on NASDAQ, S&P will likely move to a new high. The red oscillator bar on the NASDAQ, we tried to get a bearish reversal of conditions and we couldn't do it. You couldn't close below the cloud and you ended up jumping back up and closing above the 10 period moving average. So we couldn't get a reversal of conditions on the NASDAQ today. Now, if the rally is to continue and the NASDAQ tries to go fill that gap, then we can flip right back to a green bar and this would mean nothing. If you get a reversal of conditions by Friday's close, then we might get another red bar. It might mean something and the S&P might join with it. If NASDAQ goes and fills that gap back up over here, then S&P 500 is likely going to move to a new high, and they'll probably diverge from one another. By the way, we got that third cut from the Fed, and we're seeing the Fed funds rate drop here in purple. And again, in past, when we've seen this happen, it's been associated with recession and with bear markets. Now, they didn't let a bear market happen right here. They papered over it. We got a 35% drop, but it was a crash in the larger bull market. It was not a bear market. Don't get 3.5-week bear markets. Like the 2022 sell-off was not a bear market. It was for Bitcoin, but not for the stock market. Never took out the 200-period moving average, the 200-week moving average, I should say. We never took out the 50-month moving average and stayed below it. Bounced up those levels in both of those cases. This is dropping, and it looks very similar to what we had back over here. Very, very similar. And again, before we got the crash of 35%, I keep telling you, we're going to see a very ugly sell-off. We're going to play catch-up to Bitcoin very quickly. Once all this begins to unfold, institutions let the market run back up so they can sell back into it. It rallied back up on lighter volume. But don't ignore this. The rate cutting campaign has been associated with the bear markets. As the Fed did QE 2.0 right here and the government passed out a bunch of checks, now the herd believes that this is the norm right here and this was an outlier. We had a massive sell-off, 35%, but recession, the bad recession that we should have had, the bigger bear market that we should have had, we're going to have. It's going to be worse. It's going to be worse than the financial crisis. They just let it happen rather than trying to paper over it. Made matters worse, and they gave us all the inflation. Yes, it was the Fed and QE and the government that gave us all this inflation. We know the yield curve is telling us the yield curve had the longest inversion in history, and it uninverted, and then it kind of went sideways, uninverting, reinverting, uninverting, back and forth. But right now it's turning up. This is the 10-year 3-month, and again, the 10-year 2 years also doing the same thing. And again, if we begin to see, again, what looks like could be starting here, the steepening of the yield curve, it could terminate this whole thing. Now, I've talked about whether we get something like what we had in 2022, the lower window down here, the S&P, whether we get a double top divergence pattern and we go up and we slam into the trend line one more time, or do we get a lower high and begin to turn down and start taking out the low that occurred just before Thanksgiving? But just be aware that we're starting to see this steepen, and the steepening of the yield curve has been associated with sell-offs. In 2007, when we peaked, we had the steepening of the yield curve, the uninverting of the yield curve, it inverted again and then uninverted. We began to see this steepening of the yield curve, and eventually the markets began to sharply sell off. We had the Fed panic in 2007 after recession. The shaded area already began, and we dropped 20%. 2007, the October cut and the December, which we peaked the day of the October cut, at least so far, they were both associated with sell-offs until the Fed panicked. And I think you're going to see that again. So we'll be watching, and this is the weekly chart, watching if the market starts selling off sharply and playing catch up to Bitcoin. Again, we could see at the beginning of the year, the Fed panic. I think it's going to be by January, but if I'm wrong, it could be February or March. I think you're going to see the Fed panic. They're saying they're going to pause. That's not going to happen. They're going to immediately have to reverse that and do emergency rate cuts because they're blindsided to what's about to happen, and that is a recession. Think that, we've taken steps and we're going to prevent a banking crisis. They're not going to be able to prevent a banking crisis. Again, in 2007, when the Fed began their rate cutting campaign, we went to a new high. Then the October meeting, it was associated with the sell-off. Well, in our situation, the October peak so far was the high, and that created that was followed by a sell-off, I should say, the October rate cut. And then we rebounded. We sold off with the October rate cut, which is what we did. S&P dropped nearly 6%, NASDAQ dropped 9%. Now we've rallied back up. S&P's very close to the highs. NASDAQ is a little bit further away. But here we get the December cut in 2007, and that was associated with a drop that ended up dropping over 20%, about 20.5% from the high. We got a significant drop. Do we see a sell-off surrounding the December cut? It's a hawkish cut. Fed is pretty much pausing. We could see a sell-off. Next week, we're going to get the jobs report. Next week, we're going to get the inflation data. The inflation ticks back up. that could trigger a sell-off. We'll be watching. If it's cooler for now, maybe we see the NASDAQ and S&P get this divergence before the sell-off and we get that double top scenario. Regardless of whether we get a double top or a lower high scenario, we're likely going to move down and play catch up to Bitcoin. It has already confirmed a bear market. You can see my latest Bitcoin video from earlier today at the end of this video. And just be aware of this though, because by the time we had this sell-off to kick off the bear market, the market was pricing in the recession. The recession had just started in December. By the time the Fed did emergency cuts, the recession already started. And this is why I keep saying, I think the recession either starts this month in December or in January, but we won't know that until towards the end of 2026. They'll tell us when the recession actually started. The Fed is usually late to these things. And here they are pausing right before a recession starts. You can't make this stuff up. The market gapped lower and then rebounded back up. S&P went back, filled the gap, and closed higher. NASDAQ closed negative, and it didn't fill the gap. So I'll be watching this gap for the balance of the week here going into the Friday session. This is the 5-minute chart of NASDAQ 100, not filling the gap, not moving above previous high. Again, it was hit with AI sell-off, but then we had the recovery towards the last half of the trading session. NASDAQ still closed. NASDAQ 100 still closed down about 90 points, down 0.35%. Well, S&P squeaked out a gain. NASDAQ 100 did not. The Dow moving to new highs, but it's going up and slamming up into the trend line again, and we have, which my trend line slightly moved on me here. I love the charts, but when you hit save, sometimes they move on you. But we're hitting, what's interesting is the transports is hitting the trend line from the 2020 high, which is interesting. It still hasn't moved to a new high. We had a divergence in the more recent price action, the Dow moving to a new high, that went away, the transports, and this is the weekly chart, still below the peak over here in late 2024, still below the 2021 high. So again, there is still a larger divergence, but the one in the most recent price action is gone. And often there is a Dow theory sell signal where they diverge from one another at turning points. We'll see if this larger one is in fact that divergence. Now, last time we hit the trend line here on the Dow, we got a topping tail. Do we see another topping tail at this trend line? NVIDIA sold off, but then it recovered. We have a possible bottoming tail, down more than 3%, ended down 1.5%. You've got this possible right shoulder. We've turned off the 50-period moving average, a green line right there. 10 and 20 are still below it. I talked about the gap up here. We have not even come close to that level. We may fill that at a much later date. The right shoulder still has more time needed to be carved out. NASDAQ can still try to fill the gap, not from today, but the gap previously near the high. And if it does, then S&P and NASDAQ might diverge, and you might get that double top pattern on S&P. It goes back to fill this gap that we had today. Then I'll be watching this gap directly overhead. Again, back over here, shortly after we peaked, we got a lower high and we gapped down. We never did fill that gap. If we do attempt to fill that gap, S&P might push higher. Now, these highs over here, we got a lower high with the Fed. S&P pushed slightly higher. If we go back up, we fill today's gap, and we try to fill this gap back over here, S&P might make a new high and get the 2022 type of a scenario where it diverges with the NASDAQ. I told you we were going to get a rally. I told you that going into Thanksgiving, we were going to get a rally, and I told you it might go into the Fed. I told you in 2007 we got sell-offs with the Fed. I think that's likely going to be the case. If we end up seeing the scenario where the S&P moves to a new high, NASDAQ goes back and fills this gap, S&P can move to a new high. Now, I'm not predicting that will happen, but it could happen, and that's why I'm taking the time to share that with you in each video, because it is possible. I told you the institutions, they'll let it run back up. Maybe they'll let it run back up a little bit higher, but they're going to run it back up and start selling. We're already now seeing a little bit of selling again today with an AI sell-off, which is what we've been seeing with the NASDAQ. We've been seeing distribution and an AI sell-off. You're witnessing the beginning of the bursting of the AI bubble. Well, I'm showing you that head and shoulder pattern that's forming on NVIDIA. But it got a hammer today. So again, is that right shoulder not done? Do we buy a little bit more time? If we do, could NASDAQ fill this gap right here And if it does, S&P could possibly move to a new high. The Dow did move to a new high, and the Russell, but the Russell's forming triple negative divergence in the weekly time frame. Dow has divergences, and so does NVIDIA. Look at NVIDIA's monthly chart. You've got these negative divergences going on, but the Russell weekly chart trying to overthrow right now, trying to overthrow this trend line, which I've excluded the shadow. If we include it, we're right about at that level, but I'm making it parallel to this lower boundary, excluding the shadow here. Do we get a topping tail before the end of the week here? Do we see a sell-off on Friday? But you're forming the negative divergence on the Russell in the weekly time frame here on the MACD and a triple divergence up here on the RSI. Now, sometimes the Russell and the S&P diverge from one another at turning points. So if the S&P can't make a new high, that would be telling. Things to be paying attention to here on the Russell. And the Dow, as they're moving to new highs, so far the S&P and NASDAQ are not. Forming major negative divergences on the Russell, that's a huge red flag. Test mode on the, let me just zoom out a little bit more on the NASDAQ 100 from the April trend line here with the original trend line breaking and back testing. We're back testing this one, but today, again, you're trying to get bottoming tail along with NVIDIA. We go back and try to fill that gap from the previous high and the gap lower, or do we see this roll over immediately? You're watching the stochastic rolled over, turned back up. I'll be watching to see if it rolls over again. Do we confirm a lower high, or do today's candles have any meaning and buy a little bit more time? Remember, we have those hanging man candlesticks in the monthly time frame. I'm watching to see by the end of December, do we confirm those as reversal bars by closing below November's low? This potential lower high scenario, but here you can see the hollow red candlestick. We dropped below the 10 period. We closed right at it. So again, I'll be watching. Do we try to fill this gap? If we do, does S&P try to move to a new high or not? We saw the peak over here off the major channel of resistance in the weekly time frame. We dropped nearly 9%. Expected to rally back up. Greater volume, we got it, but right now, signals are still hanging in there. We did get the awesome oscillator turning red today for the NASDAQ with NASDAQ futures, ES futures. The S&P didn't do it. The S&P tried to do it at the at the lows of the session and during the sell-off, and we closed positive and it canceled it out. We're watching to see if this is a bottoming tail and we go back to fill this gap. We move down to take out the 50 period and the 20 period moving average down here. Right now we're trying to bounce here after dropping below the 10 period. We're trying to bounce. We're hanging and holding above it. Even though we were down, we didn't close at the lows, and you got a possible bottoming tail. This bottoming tail we got over here, we went higher, but it gave us a lower high. So even if we go back higher, fill the gap, you could still see a lower high on NASDAQ. But if that happens, if NASDAQ fills this, then S&P might join the Dow, make a new high, and get that 2022 double top scenario, diverge with the NASDAQ. S&P came back and filled the gaps and is moved just to under this level over here. If NASDAQ does try to fill that gap, S&P is likely going to push up to a new high and slam up into the upper channel line. Going higher, we are forming a divergence on the histogram, which is the difference between the MACD line and the signal line and the stochastic. But again, you still might reach new highs. It looks like a possible double top scenario like we had in 2022 could set up NASDAQ and S&P diverging from one another. That would be a double top. And the double top, what usually happens is you come up here and you go just slightly above this high right here, and is what happens. Triggers all the stops, and then they institutions then they dump it. That's why so often with the double top you see the second peak, it triggers all the short squeeze. It rolls over and you get your double top and you come back down. Whoops, I didn't do that right. Then you get your double top and then you come back down and you move to take out the slow, which is the confirmation line. It's a McDonald's pattern. Now, when we did it in 2022, we moved just over 1.5% above this high right here. Directly overhead, you have the upper channel, as I've talked about on the S&P 500 weekly chart. I've talked about this channel from the 2020 low, and again, if we do what we did in 2022, you'll see something that looks just like this, where we go up and we hit the trend line or just overthrow it or something and then turn down. This ended up giving us a 27.5% sell-off. But do we get something like that 2022 top where you form this little miniature double top, where you get one peak, I have the red arrow there, and then another peak like that, slightly higher, and then this follows. Hit the upper channel line here with our October high. Again, here it is up close. The last time we overthrew that trend line ever so slightly but couldn't close above it. And we got the topping tail, the gravestone doji. Now we're coming back up. We're less than 1% away from that trend line. If we reach it this week, assuming that we go higher, get that trend line directly overhead. Now, you may overthrow it, but again, if we do move to new high, at the 2022 top, above this peak, we only moved about 1.5%, just over 1.5% above that level. If we do make a new all-time high on the S&P, you could see something similar to that double top that formed in 2022. S&P it gapped lower during the session today, but then it went back and filled the gap. NASDAQ did not. And we got a little rising wedge. Now, is that just giving us a pullback and we're on our way to make new highs? Form divergence there, but NASDAQ goes back to fill today's gap and the gap off of our previous high, then S&P could try to diverge with NASDAQ as it did in 2022 that I've been showing you all week. Rally back up and forming the rising wedge and then breaking down at the end there. It did form this divergence, but there is still risk of the S&P trying to push to a new high. This is the 15-minute chart. Divergence may not be done. The S&P is within striking distance of making a new all-time high. That's what it did in early 2022. After Bitcoin peaked and collapsed, and then NASDAQ a couple weeks later peaked. S&P was last. Do we see something like that again? Not only do we have a divergence in the 15-minute time frame, but you've got one here in the most recent price action here in the 60-minute time frame. We went higher. The RSI did not. So you got a little divergence there. And then you've got this larger divergence, this multiple point divergence with these previous highs. Now again, we are within striking distance of this high over here, but you're forming this multiple point divergence. Again, we could see a short squeeze, have it reverse, or immediately or thereafter in a few sessions. If we can't make a new high on the S&P 500, this divergence has to play out by taking us back below the 50, back below the 20, back below the 10 period in the daily time frame, back below the 50, the 20 and the 50 in the daily time frame. But there's a divergence here. Whether it can produce a reversal remains to be seen. And again, it may not be done yet. The MACD is turned up. We may be forming a larger divergence at a new all-time high. So keep that in mind. 2022 scenario is still possible. And here it is up close on the weekly chart. Again, went slightly higher here. That gave us this divergence. You already have a divergence here in the weekly time frame with our previous high. I should say our last high. But if we exceed it, then again, we're going to go slightly higher into the trend line, and you would form a triple divergence. Right now, the Russell is forming a triple divergence on the RSI, but sometimes S&P and the Russell, they diverge from one another. You've got that possibility here on both the MACD and the price oscillator, and the price oscillator is making a lower high than the previous peak over here, forming even a larger divergence. Whether these form divergences or not remains to be seen, whether the RSI will form a triple divergence or not, but it's something that could happen. The stochastic formed a divergence up here as well, but could form another one as well if we do try to see that 2022 scenario end up forming, which would be a double top scenario. And again, we had a double top over here at the February high. We peaked, we went slightly above this level in February, slightly above the December high, and then you got your sell-off of 21%. Do we form another double top like in 2022 and February of 2025? Be watching, or do we get that lower high scenario? Right now we're bouncing out that 20-week moving average. If we get a lower high, we've got to come back and take out that 20-week to start a bigger sell-off.